of the Apollo 8 crew and took the famous Earthrise photo in 1968. His small plane went down in the water north of Seattle. I'm Chris Coraggio, NBC News Radio.
NBC News on KCAA Loma Linda is sponsored by Teamsters Local 1932, protecting the future of working families. Teamsters1932.org.
You're listening to an encore presentation of this program, KCAA, the Inland Talk Express.
Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for the Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. This week, as well as every other week, we come to you in the Southland, in the IE, in the Inland Empire. A lot of interesting news going on in the Inland Empire, up in Menifee as well as in Victorville. A couple of things that came across the wire that I thought was very interesting. I'll get to it a little bit later in the show. I am Jeff Barton. This is the Mortgage Voice. If you want to see us, you can go to KCAA.com. That is the radio station. You can also hear us on that radio station Saturday and Sundays. And we come to you via YouTube as well. Jeff Barton, the Mortgage Voice. That's my particular show on YouTube. I just looked the other day. Hundreds of people, over a couple hundred people who are regulars that come to the show each and every week, not necessarily from the IE, but from all over. They like the perspective that we give, both as a national perspective on a bunch of different economic topics, as well as what's happening local here in Southern California, specifically in the Inland Empire and the cities in that area. I want to welcome you to the show, and thanks very much once again. We always try to bring information to you that you can use, things that might stand out to you in terms of decision making, whether it's the rates themselves, whether it's some of the opportunities of programs that you hear from the guests that come on the show. It's all good information. It's all really what we're about and what we try to do on a weekly basis. Let's get right to it. Again, I'm Jeff Barton, and this is the Mortgage Voice. Let's get right to it. As I said, 30-year fixed-rate loan at 7.09. Now, it was about 7.5%. It has come down some. We've seen this bounce up and down quite a bit over the last 6 months, probably like this through the end of the summer. Why do I say that? Because the economy itself is in a bit of a bounce. Inflation's up 1 month, it's down 1 month, but really it is held very steady at about 3.5% for the last year. 6 months to a year, absolutely. And because it's funny season, i.e. the election for the President of the United States, a lot of other local elections coming up, the markets have determined that this is kind of where we are and where we're going to stay. Until inflation comes way more in line with what the Fed sees as a 2% inflation rate, we're not going to see the Fed lower their rate, and therefore, tangentially, the mortgage interest rates will also fall. That's what we talk about a lot, why the interest rates are what they are, the difference between the Fed rate, the difference between the mortgage interest rate. These are the things we talk about on the show every week, and we kind of hammer that particular part home, because as a borrower, you're out there right now and you're saying, hey, if I can get a loan at 6% versus 7%, it's going to save me $100 per $100,000 on the loan per month, meaning that if you have a $500,000 loan and it's 8% versus 7%, it's going to cost you an extra $100, which is $500 on a $500,000 loan on a monthly basis. And over the year, that's $6,000. Over 30 years, well, you can add it up. That's a lot of money. And so anytime that we're talking rates, how they get there, why they get there, it's really important to listen up, because you're the one that's got to make the decision when you pull the trigger on the house. Now, most of the guests that we have on the show, i.e. the account executives, the real estate agents, all the vendors, they make their living off of you, the buyer, the person that comes in and buys the home. Why? Because they're selling you the house, or they're getting you the mortgage, or they're fixing up the house, or they're appraising the house, or they're doing the title work, or they're doing the escrow work. There are so many industries that wrap around the sale that you want to have when you get out there in the marketplace and buy a house. So we are beholden to you. Now, as everyone knows, the market's terrible, and we'll get to that a little bit later in the show. Let's see, the 15-year, 6.56%. The FHA is at 6.62%. The jumbo is at 7.35%. The VA loan is at 6.64%. The 2-year is at 4.8%. The 10-year is at 4.4%. That spread between the 2 and the 10 has remained about 40 basis points there and abouts for the last 3 months. That steady hold, i.e. between the 2 and the 10, tell you that we are in a very, within a tight range, a pretty stable market. I mean, if we say that between 6.5% and 7.5% rates are going to be like that for the next year, you could say, all right, that makes some sense. Well, this is what the 2 and the 10 are telling you, and the prices that we get on the bonds that are sold en masse. And by the way, we sell a ton of U.S. Treasuries as well as corporate bonds as well as all kinds of other bonds. And on a by-the-way access, the Chinese government is selling foreign sovereign bonds in order to prop up their real estate sector. Their economy is not doing well, which is why you see, in my opinion, of course, the rattling of sabers between the Russians and the Chinese and the anti-U.S. rhetoric, because it keeps their domestic people satisfied. It focuses the attention on somebody else. We do it here in the U.S. all the time. We start to talk about, especially if an administration is in trouble like this one, politically, they start talking about other things, whether it's, free giveaways or wars in other areas. If there's an election coming up, both sides do it, which is exactly what happens. Let's distract the people from what's really going on in their lives, and let's face it, what's going on in their lives is the same thing that's going on in my life. I go to the gas pump, prices are up. I mean, they're up. And I read the other day, yesterday, as a matter of fact, that we're again expecting slowdown at the refineries. Why is it always a slowdown at the refinery in the summer? Why is that? Why is it always maintenance in the summertime? It just makes me absolutely insane. When we need the gas the most, and in California we blend our own gas for the California market, and each and every summer that amount of gas is finite. And because of that, the prices go up in California more than any other state, because what we demand of gas in California is different than what they demand of gas in Montana or Oklahoma or Rhode Island, for that matter. And so as a result of that, we pay more, and as a result of the refineries going offline or being maintenanced or whatever else they call it, we'll have less and less of that gas that is eventually going to push the gas prices even higher. So in a blue state like California, does it even matter? Yes, of course it matters, because not only is your vote, but you've got to go and pay these prices, and I think that has become one of those things whereby everybody who buys gas in California just accepts it. I think it's terrible. It's a bone of contention that I pick at all the time. It just makes me absolutely incensed. Not only that, but you go in and you buy a bag of chips and it's $5. I mean, I'm exaggerating, but not that much. I mean, the inflation on items that you buy every day is what's driving people insane. It's why the Michigan Consumer Index is down again this month. People look at the economy and they read what they read. It's the same things I read, but then they go to the nuisance items that causes them consternation and I don't know what the word, aggravation, right? It aggravates me too. So I recently, yesterday, got back from a trip. I went to see my children. I have a couple of kids in New York City. Yes, don't go there if you want to save money or if you don't want to really see what inflation is doing in the major cities in the U.S. It's unbelievable and it's crazy. So out to dinner, 6 people. Guess what? $600. $600. Now, so I know some people out there going, that's what I pay for rent on a monthly. I know the one-bedroom rent in the U.S., which has been going up and did go up during the pandemic, actually has come back down quite a bit. The average is about $600 to $700 for a one-bedroom or a studio in most of the country. But in New York City, no, it's not like that at all. It's more like, I don't know, my brother was saying he could buy a studio apartment in New York City for between $400,000 and $600,000. You think about that for a second. The median price of homes in the Inland Empire is about $550,000. Okay, so if you're looking at a place to go, you could buy a house and a piece of land in one area of the country, which is still expensive at $550,000. You can go and buy a shoebox in New York City for the same amount of money. It drives me insane. I don't know why that is, but these are the everyday items. Shelter. You got to live somewhere, so either you're paying a lot in mortgages or you're paying a lot in rent. You still got to live somewhere. That's what irritates people. Food costs, we didn't even get into it, but they are astounding and out of this world in terms of when you go. I bought 3 items yesterday, $34, and it wasn't like I was buying the most incredibly outrageous items ever. I think it was a loaf of bread, I'm not going to exaggerate it, a half a pound of turkey, and one other item, $34. I looked at this person, I went, are you insane? Who's going to pay for this? And of course, I live in the community that can't afford it, so I don't even think they look at the thing. But I'm cheap, I'm Yankee cheap. Grew up in New England, that's the way it was there. You look at every receipt, you make sure that everybody's, giving you what you're paying for, but $34. Anyway, these are the things that are on my mind, and I'm probably on your mind too. It is Jeff Barton. I am the Mortgage Voice, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Got fired up a little bit earlier in the show talking about inflation and the way things are, even for people who are in the place and position in their lives. I'm 70 years old, so I should be able to afford certain things, but the inflation is killing me. Anyway, Jeff Barton, the Mortgage Voice. If you want to see us, hear us, kcaa.com or the radio station, Saturday and Sunday, you can come to it. We're also on a number of different podcasts. Daryl, can you have a list of those, or do you?
I sure do, Jeff. We're
Perfect.
on Apple Podcasts, Google Podcasts, Spotify, Spreaker, Stitcher, iHeartMedia, Odyssey, YouTube, podclips.io, and themortgagevoice.com.
Thank you very much. Yes, podclips.io. I always plug them because I like them. They're nice people, and the people that I know that are invested in bringing to you great information on that podcast, podclips.io, is a central location where you can get a lot of different podcasts. I'm on that. I'm in the financial area. I have a friend of mine, Gary. Was Gary on the show? No, he's not on podclips.io.
I don't think so.
No. Oh, why not?
He should be.
He should be, exactly. Yeah. Anyway, Josh brings you a health show. Had some great guests on the other day. We also have a...
Mark Allen's on there.
Oh, Mark Allen, that's who it is. Mark Allen, another great podcaster. Mike, what's Mike's show?
Mike Anderson is the Anderson Files.
Right.
And he's a financial advisor.
Right, exactly. And the ADR guys, the alternate dispute resolution people, who are they?
Len Levy.
Okay, so I just mentioned 4 different ones in the realm of things that you want to listen to. These are the guys you want to turn it on and tune it in. Anyway, podclips.io, go there. Great podcasting. I'm Jeff Barton. This is The Mortgage Voice, and welcome back to the show. Headline CPI in April down 0.1%, 3.5% to 3.4% year over year. That's a good sign. It's well within the limits of what they determined was normal or was what we're expecting. You know, the Fed, when they talk, and I'm sure that anybody out there who listens falls asleep like most people do when Jerome Powell speaks. As an aside, quickly, Jerome Powell, he's got the vid. That's right. He contracted COVID a couple days ago. Finally got the word out from their press people that he should be okay. But so when he's gone, who's minding the store? Well, there's, 16 Fed governors, and there's plenty of people there there's a vice chair, and I forget that person's name right at the moment. But regardless, how is it determined, and what is it that you look for when the Fed speaks? We're always talking about inflation and why we're not lowering interest rates. The Fed interest rate is, of course, different than the mortgage interest rates, but they work hand in hand. It's kind of like soap and water to mess, right? I mean, they're not necessarily the same thing, but they go together. And if you don't have one and you don't have the other, yeah, you can still clean it. But at the same time, that's a terrible analogy. Regardless, I don't care. Core inflation, minus food, minus energy, is at 3.6%. It's the lowest it's been in 2 years. That's a big number, by the way. And as I was saying in an earlier part of the show about food costs and how it's just driving everybody insane, because everybody's got to buy food, and everybody goes to the grocery store, and you notice things that go up, and they have been going up really outrageously so. If, in fact, we see some movement, and as the Fed said, we haven't even really begun to see the effects of high short-term interest rates on the economy. Now, that is going to make everybody insane because we're paying, higher credit card rates, higher auto loans, and other aspects which are affected directly by the Fed rate. And so scratching your head going, what do you mean it hasn't affected the economy? Well, what they mean is it hasn't slowed down the economy. We saw some signs of it last month, but again, this week we've seen fewer people file for first-time unemployment insurance, and that is a sign that the economy is still in pretty good shape, still rocking and rolling along. I did see some estimates on the Q2 and where we're going to have GDP, and it's like it has been. I mean, we'll have the Atlanta Fed be at 3.3% growth in the second quarter, yet we'll have Bank of America at 1%. So that range of 1% to 3.3% is where we think the economy will be, and of course that's a huge difference. If it's at 1%, we're going to say, oh my gosh, the house is falling. I guess the rates that the Fed has been charging is finally kicking in. We're going to see a slowdown. If it's at 3.3%, we're going to say, hey, you know what, higher for longer. That's what we're doing. We're going to see the rates that the Fed has charged continue to stay where they are, and we're not going to get that boost by lower interest rates from the Fed. So it really depends. We're in the first month of the second quarter, and we'll just have to see where it ends, or the second month of the second quarter. We're about halfway through. We're at the 15th, 16th, 17th, 18th of May, and so, yeah, we're about ready to hit a time in the real estate market and in the mortgage interest rate market where the summer buying season is either going to happen or it's not going to happen. We've seen some indications that more and more inventory is coming to market. That's because a lot of buyers have given up. They just said, you know what, I'm throwing the towel in for right now until we see better interest rates or lower real estate prices. I just can't afford it anymore, and that's as true today as it is in any market. Obviously, those constraints on any borrower, on any buyer, are going to make them think twice about laying out 20, 25% in order to get the property that they want to get. Now, in the Inland Empire, as I was mentioning earlier, there are some signs that that particular part of California is catching up with the rest in terms of, higher real estate prices. We did see an overall growth in population, which was kind of a surprise in the Inland Empire. But as prices on the coast, and this is a great indication for anybody who's looking at long-term effects of what's happening in the economy in Southern California. In the Inland Empire, they are the last to raise prices to current Southern California prices, i.e. either percentages or the actual prices. Now, as I mentioned, $550,000 is the median price for a property in the IE, and that's pretty high. We also have seen let me just get that up here for a second. Menifee added 2,000 people to their population, and Victorville population is 140,000. That's a big number, right? In LA County in of itself, that is a huge number. In the San Bernardino Riverside County area, those are big numbers. So given that we have seen not only prices rise in most of Southern California, what we're seeing in the Inland Empire is prices have actually fallen 2.5% this year. So there are some opportunities there that you can get into because the inventory's risen and prices have fallen, and we're getting reduction in prices that are listed to the tune of about 30%. Maybe an opportunity for you to get out there in the marketplace and see what's happening. I know a lot of people, as I said earlier, are bailing because they're just fed up. Now, when that happens, you stop paying attention to the marketplace, which is not a great idea. You have to have a nose. You know what? Hire an agent. That's the best way to do it because that's what they're paid to do. Now, I know agents are pushy, and of course, that's the way they make their living. Hasn't been great for the last 2 years, either for the mortgage people or for the real estate people. And with that real estate lawsuit finally behind everybody, there is still some concern as to how buyers agents are going to get paid. Once that's worked out, you really need a professional working for you so that they can keep their eye on the marketplace. Not to just buy, but just to follow the trends. Now, there are plenty of real estate agents who would be willing to do that right now just to have the opportunity at some future date to represent you in the purchase of a home. So get somebody on it, get somebody to watch that, because as I said earlier, most buyers have just said, you know what, enough is enough. I can't afford the rate, can't afford the prices, and right now I guess I'll just keep renting. We've seen rents come down significantly, although in the IE, surprisingly or not surprisingly, because people aren't buying, rents have actually stabilized and have maintained that momentum to price pressure on the upward side. So all of that being what it is a great idea to work with a professional in your area to make sure that you're on top of what's happening when there are opportunities available to you. I just described the IE and what's happening there. In the total population in the Inland Empire, I didn't get to that point, it had gone up 67,000 people over the last year. So of all the places in California where people are leaving, actually people are coming to the IE. And the reason is on the coast, the prices got too high, then people start moving in. When you see prices dip like this, it's more of a reflection of what's the overall economy, whether it's unemployment, whether it's inflation, whether it's other factors. And I can't think of another factor right now, but I'm sure there's tons of them out there. If you're in that marketplace and you are looking around, keep looking. Like I said, I think there will be opportunities more opportunities later in the summer. I don't think right now at the beginning of the summer there are as many as there will be. We've seen, yes, population go up, but real estate prices come down. And those two things combined means that at some point we're going to have a demand issue, meaning that there'll be more demand entering the marketplace. Isn't there yet? Get somebody to work on it. Make sure that you're on top of the situation. I'm Jeff Barton. This is The Mortgage Voice, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us on a weekly basis. We come to you in many different ways. We have podcasts, we have the radio station, KCAA, and we're also on YouTube. Our website is called themortgagevoice.com. I went there the other day. There are great people on that website. Guests that come on the show, we put on the website. Ways for you to get in touch with them, either by telephone or email, perhaps. And obviously, you can listen to their excerpts from the show. All of these things are available to you in many different formats. In today's world, you have to deliver the information the way or wherever the people are. It used to be, when I was a kid, that you had to come to the information. Now the information has to come to you. I think it's a better way, but all these ways are available for you, themortgagevoice.com. I'm Jeff Barton. This is The Mortgage Voice. Thanks for listening to the show. Okay, so we get into what's happening locally here in Southern California, these portions of the show, and I always like it best because I get to talk to friends and people who've been in the business a long time, professionals who are way better at it than I am. Connie Hernandez, who is a longtime regular to the show and has graciously accepted the invitation to come back again today, and I appreciate it. She joins us now. Connie, how are you?
I'm so fine. Thank you for asking, Jeff. Always happy to be on the show.
Excellent. Thank you very much. Okay, so we're in the latter half of the springtime here. What happened to the spring buying season?
Well, we're still dealing with a lot of buyers, still having a difficult time finding the right properties, and we're still competing for properties. We've had quite a few listings in the first quarter, and most of our listings were multiple offers. And they sold with, I would say, out of maybe 12 listings that we had that were in basically working on them, within probably 3 days at the very most. We have already quite a few offers. There was only one, which was kind of in Hesperia, which obviously is a little bit out of our area, but that took a little bit longer, and it seems that one fell out of escrow twice, but we put it back in an escrow probably within 2 weeks and closed probably 3 weeks after that. I'm still seeing a lot of buyers. It's just properties, there's just not enough inventory.
Yeah, it's so funny because I read how California has really increased their particular inventory, and certainly that means San Bernardino, Riverside counties, L.A. County, Orange County, all these, Southern California have increased their number of listings, but not that much, right? I guess it's still pretty scarce out there to find something in a price range that you can afford.
Not enough.
Right.
Not enough, because I do have a substantial amount of pre-calls that I'm still waiting for properties for those buyers. And, I think a lot of our buyers that were kind of have put the brakes on a little bit,
right,
realize that, this is reality, and the only alternative is if they can. And they can afford to buy right now, they're buying in the expectation that the rates will drop and they'll be able to refi later.
Yeah, I think that's a good strategy. I don't know if I would bank on it, but certainly, in this climate where we're waiting for inflation to get under control, according to what the Fed says, when they drop, the mortgage interest rates will tangentially drop as well. That's my opinion. I'm watching the 2 and the 10, and they're still 40 basis points apart. So the mortgage world seems pretty set on between 6.75 and 7.25%, at least over the short term for the next 2 or 3 months.
That's what we believe, and despite the fact that we were told the rates should drop by now, they
Sure.
just haven't done that.
Sure. No, they always tell you that, and then they charge you double. It's kind of like, at the grocery store. No, when the supply chains come back, everything will get cheaper. Well, it didn't get cheaper.
Has not.
No, it never got cheaper. It just remains sky high. Buyers' concerns, what are they mainly? Is it just that they get tired of looking and they just give up, or what is it?
I think that for the most part right now, what I'm seeing, at least in my area, the biggest concern is the insurance.
Right. That's right.
The down payments obviously are always, concerned, but we have plenty of DPA programs right now. Although I haven't really had to close to many of those, but
Okay.
right now insurance seems to be the challenge in certain areas. I mean, if you can get insurance, it can be pricey.
Now, that's interesting that you say that, if you can. If you can't get insurance, you can't get a loan. Isn't that right?
Well, if you can't get traditional insurance, there's always California Fair Plan, right?
Okay.
But even California Fair Plan has had its challenges in
Right.
wanting to actually insure properties, which I've always, 30 years of being in the business, California Fair Plan was, to me, the go-to if everything else failed, and
Right.
it was more like they had to help you. But they've actually had some situations where they've declined to insure properties.
Right. Now, there has to be a legislative answer to this here in California, and I don't hear peep from anybody in Sacramento. And it just, it's like, it's the elephant in the room. Nobody wants to talk about it. If I can't insure my property, the property's worth nothing. And
Absolutely.
I have been in my property for 30 years, seen some great inflation there. I really appreciate the fact that I've got equity in it. But if I can't get insurance, there is no equity. There is no worth, because nobody's going to buy a house that they can't insure. And that really sets the market.
No, we had one situation where we actually were able to get insurance after several attempts. And believe it or not, probably 2 days before closing, they sent a letter saying that they were not going to insure it after all.
Oh, man.
So we had to go with California Fair Plan on that one, even though the borrower obviously was not happy about that.
Well, no. I mean, they're stuck between a rock and a hard place. And, who are they going to blame? They're going to blame the real estate agent. Of course. Who else would they blame?
It's always the lender's fault.
Yeah, or the lender. Right, exactly right. I mean, somehow you screwed it up, and you're like, wait a second, I don't do insurance. Yeah, exactly.
Yes, the water heater breaks, and it's our fault.
I know. Okay, so on the lending side, what are some of the programs that you're using? You mentioned DPA, although you haven't done so many, you said. What are some of the popular programs you've been using for some of these borrowers?
I've actually closed quite a few, which was not really my area of expertise up until last year. I-10 borrowers.
Okay.
There's a really amazing program out there for the I-10 borrower as long as they're self-employed.
Okay.
They are actually offering like a 3.5% down program for an I-10 self-employed borrower. Of course, they have great credit and stable income, but for the most part, I mean, I've been able to close a couple of I-10 borrowers that are own restaurants, or one of them owned a clothing cleaning service.
Okay.
And they, substantial income. So those were fairly easy for for me to close, especially because, again, it's not really my area of expertise, but definitely a new market for myself, which I'm, hoping to explore this year.
Now, the I-10 market, these are people who are looking to get a loan off their business. Is that what it is?
No, this is a home loan.
Okay.
In the past, I kind of stayed away from that because they always required really large down payments, 30% down, and you had to have great credit, and you had to have great reserves, and your ratios were really low. But a lot of that has become a little bit more lenient, where the ratios are now more reasonable. You're talking about 43, 45 versus before they were in the high, like 37, 36.
Okay.
So with that being said, I honestly, this is probably the first year I've ever seen an I-10 borrower, as long as they're self-employed, that could purchase with such a low down payment. Now, W-2 I-10 borrowers are still the best program out there, is still a 10% down, which is not bad because in the past it was always minimum of 20% down.
Okay, so that's an interesting loan product. Connie, we're up against it here. You want to shout out a way by which people might be able to get in touch with you, either these products or representing in a home? I mean, we're doing it all right now, so let people know.
Thank you so much,
Sure.
Jeff. And yes, you can reach us at 626-422-2017. That is my direct number. Our office number is 626-918-2419. We are in the city of Covina, 101 North Citrus. And again, this is Connie Hernandez. I'm happy to answer any questions you may have. I do specialize with reverse mortgages, and now getting becoming an expert on the I-10s.
Excellent. Connie, thank you very much once again for coming on the show. Always love having you on.
Thank you, Jeff.
Thank you, too. That's Connie Hernandez from PMA. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us on a weekly as we bring to you the news to use, as well as other information that can help you in your decision-making process this summer. Obviously, summer's right around the corner. We're at the end of the spring buying season in the IE, but certainly in Southern California, and a lot of what's happening around the country is the same, right? Prices going up, not enough inventory, mortgage rates going up. How am I to afford a house? How can I get into one? What's the best plan forward? And of course, that all depends on you. You are the person who's going to set the agenda by, what kind of loan do you want? I mean, do you want the best and lowest? Well, you have to be a certain type of borrower. If you can't fit into that box, you got to be a different kind of borrower. And all of those things, you got to have an experienced person to help you, to be able to, usher you into the loan product that not only you can use today, but refinance tomorrow. And there's no better person than that than Charles Giscombe, who joins us from United Security Financial. Charles, how are you?
I'm doing great, Jeff. Thanks for having me today.
Thank you very much. Thanks for coming on the show. Okay, so here we are, as I described. We're about ready to get into the summer months where it heats up. We see low inventory. We see a lot of things. I mean, we've been talking ad infinitum about this for the past 6 months. Rates are up. Inventory's down. Prices are up on houses. How do we get people into them? The non-QM world is a world with which we know a lot about, helping borrowers who don't necessarily fit into that normal credit box. Tell me a little bit about your business and what's happening now with your borrowers.
You know what, Jeff? Absolutely. Summer months, things are picking up. Like Jeff said, inventory down, interest rates going up. Still opportunity. Prices, values and prices on homes still steady, so it's still a great market to get into. A lot of times I tell people, you can't beat a traditional mortgage interest rate, but all interest rates are high right now. I think we're looking at a 30-year fixed about 7.5, 7.6, Jeff. We're looking at a 15-year at about 6.75, 6.73. So interest rates are high across the board in general. It's that at this moment and at this time when I always tell individuals, the interest rates are not going to be too much different from the other alternative financing options that you have from traditional loans. So if you can take advantage of those things, especially if you don't have the traditional financial structure, 2 years of employment that way, the tax returns, W-2s, paycheck stubs, and bank statements, non-QM loan is always a great alternative loan to get into. And more people are doing non-QM loans to the point where non-QM loans are now becoming so competitive with traditional lending that I'm quite sure that the traditional markets get a little scared. I don't mean scared, but I just mean they're going to run. There's an option next to every traditional loan that you can get into non-QM that makes it a lot easier. They provide some characteristics that are not normal for a traditional mortgage. For example, whether it's 85, 90, 95% LTV, there's no mortgage insurance. So you never have to pay the additional mortgage insurance, which is great. From a qualifying standpoint is you don't have to have tax returns, bank statements, and paycheck stubs to qualify for that particular loan. Obviously, you have to show you have the ability to repay and the ability to put the down payment down. But as far as qualifying, those financial documents, meaning bank statements or a profit and loss, take the place of the tax returns. It's a great alternative to traditional financing for individuals who don't want to show or who can't show the typical traditional financial structuring and basic needs.
You're going to light up a lot of people's ears and eyes, and they're going to say, "Oh, wow, maybe I can go get that loan." But let's talk a little bit about specifics. Credit score for these types of loans, down payment for these types of loans. As you said, down payment can vary anywhere from 80 all the way up to 95% LTV. Give us an idea of loan program and these two questions, with credit score and amount down.
Absolutely. So it used to be non-QMs will offer you that alternative financing, but they wanted more down payment.
Right.
And your credit score still had to be fairly high or above average. Well, Jeff, not today. Actually, what's happening right now is that, with a 620 credit score, 600 score, you can get into an 80% LTV, 85% LTV loan.
Okay.
But, Jeff, if your credit score is a 680 to a 720, you can put 5% down, almost like a traditional government loan now. And with your 12 months of bank statements can qualify for a 95% loan. There's some programs out there, and it's just because the private investors that are purchasing these loans are feeling more comfortable now because these are in the market and heavily looked at as truly alternative or competitive loans, especially for the particular market we're in right now. So you're looking at a 600 to 620 credit score can still get you in. Obviously, the higher the credit score, the better tier you're in, which opens up the better rates for you. But you still can get into that particular loan and get that done. And as far as down payments is concerned, you can go from anywhere from 20% down, Jeff, all the way up to 5% down with better credit.
Okay, now these loans are traditional 30 years. Are they amortized less than that with a balloon at the end? How does that work too?
Well, yeah, they actually take on the form of a traditional mortgage. There's 30-year fixed loans. All right, you can also do some interest only in that in some of these programs, but mostly it's going to be just like your traditional loans, a 30-year fixed. Some of them have arms. The beautiful thing about this loan is actually when the interest rates are higher on these loans because you're providing less documentation, they also have the ability to flex and give you a 40-year term as opposed to a 30-year term to offset the higher interest rates that are going to come along with this type of loan.
Now, traditionally in the U.S., people hold on to their mortgages about 7 to 10 years, something like that, right?
Yes.
So when you're you're talking to your clients, and you're saying, okay, so this is what usually happens. This is how an average borrower is, and within this window of whatever it is, we're going to be able to either get you a lower interest rate or a different product, or you're going to get out of the product entirely by selling the house. That's part of the equation too, right?
It's always that way, Jeff, because right now, no one wants a high interest rate, so we're looking at short-term goals and long-term goals.
Okay.
What is our benefit at the end of this? Usually what I tell clients is right now, in this climate, in this market, no one wants the interest rate that they're getting newly. If you have other individuals that have been in interest rates or refinancing, they may not want to move. They might want to look at a HELOC. But a new individual getting into this market, you have to explain to them the short-term and long-term. The short-term is all the interest rates are high, so let's get you in a loan that may be 30 or 40 years, which can stretch out the amortization to give you a lower payment. But that is just for the entry to get into this. Now, our long-term goal should be with no prepayment penalty, we can refinance this loan when the interest rates correct themselves, and then you can now get into that 30-year fixed low interest rate loan that everybody has been looking for and had 2 years or more.
Right. No, I follow that, and I like that. Insurance, there have been a lot of talk here in Southern California, maybe out where you're currently residing or where you're doing business. I know you do a lot on the East Coast, whether it's Florida, North Carolina. There's a lot of hurricanes there. There's a lot of fires and earthquakes out here. Insurance companies are dropping a lot of people. How are you dealing with that, and have you had any problems with that?
You know what? I haven't had, but people in California and Florida, more of a concern in those places where it's heavily tornado, hurricane, different things that occur. Haven't had it at this side in Charlotte, but guess what? Everybody should be alert, because what's happening now is that with the temperature change, if you believe in it or not, and what's been happening anywhere can get hit. So I'm quite sure everybody should just make sure you keep your ear to the street, and you're looking at insurance companies, because a lot of them may be dropping out the game. It gets very expensive when you're having these hurricanes in different places, especially where you normally would not have them.
Yeah, it has been a big problem out here, especially where the fires are, in my local area, but certainly in San Bernardino, Riverside counties, there's a lot of insurance issues, questions, and so shopping around may become a problem because a lot of people are getting out of the business.
Absolutely. So when you get the solid, the big boys usually are going to be the ones that are going to last the longest and stay around, obviously, the longest. So if you want to look at those companies, you have a lot of companies falling out, a lot of companies laying individuals off and just not providing insurance.
Right.
I mean, and it's because of the fear of the insurance companies to cancel or opt you out or not to renew your coverage, because there's excessive amount of claims happening in different places and all over the place. See, places that are used to having insurance claims, they can deal with it. But now you're getting it all across the country.
Right.
It's becoming very difficult for these people to bank those. So you may have some difficulty in some places. Here in Charlotte, not the difficulty. Insurance is kind of easy and still is. But like Jeff said, California, Florida, all the different places like that that are having hurricanes and tornadoes, and they happen more frequently and often, it can be tough.
Okay, well, we've run out of time. Thanks for that information. I appreciate it. If you could let people know how they can get in touch with you, terrific loan officer who works all over the U.S., commercial as well as residential, Charles Giscombe. Chuck, give them your number, will you?
Absolutely. You can reach me at 725-577-8761. That's 725-577-8761. Or you can email me at cgiscombe@usfwholesale.net.
Excellent. Thank you very much, Charles. Appreciate you coming on the show.
Jeff, thanks for always having me. Thank
always, you. Yes. Charles Giscombe from United Security Financial. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. We are always here available for you. If you want to get in touch with us, go to the website. It is themortgagevoice.com. You can contact me through there. Also, if you wanted to see the show as well as hear the show, you can go to YouTube, Jeff Barton, The Mortgage Voice on YouTube, and you can certainly get in touch with me that way. We have a number of different people who join that group each and every week. I really appreciate the YouTube listeners. You know, it's funny in this segmented market where we get audience from all kinds of different places, whether it's traditional radio, driving around in your car or listening at home, or whether it's online, or whether it's, by listening to podcast radio. It's just really interesting stuff. And because I'm new to it, I was in line the other day and I was fiddling with technology, which is difficult for people who are my age. It just is. I mean, it is and it isn't, right? But I prefer picking up the telephone, talking to someone, and having it taken care of. That's the old way. That was the technology of my era. So I turned to these two young guys, and they were in line, same as I was. I said, I hate technology. And one of the guys said, you know what? I like technology because we grew up with it. And isn't that the truth? I mean, there will be some new thing that happens after they've reached their maturity level, which is, for a guy, I have no idea, but for most people, it's 25 to 30 years old. But there will be something new that they will find difficult to adapt to. And I think adapting to the real estate market or adapting to what's happening in the mortgage market is really about acceptance. It's like, this is it, this is where we are, and this is what I got to do to get into the game. Whether you think shelter is too high priced, whether you think home prices or rental prices are too high priced, it is really about, you need these things, you got to get into the game, you got to accept what it is, and try to work the best you can. Now, if you're on a limited budget, I get it. I've worked 2 jobs in my lifetime as well. I'm still working adult at my age at 70 years old. So if you think that the people giving you advice, at least on this show, don't know what you're going through or how you can afford things, we really do. And I think that's one of the bases by which we try to provide information so that you can make the best decisions possible when you're buying or selling real estate. I mean, whether it's in your mortgage or whether it's in the real estate, whether it's in the people you work with, or whether it's in the amount of money you got to put down on the house. All of this is information we deal with, either with the guests we bring on or the different segments that I bring to the show from the information that I gather over a vast amount of years in the business, as well as what's happening today, whether it's somebody that said something that might affect mortgage interest rates, i.e. Jerome Powell said something, i.e. some Fed board governor, or some disaster that happens, a big fire, a big earthquake, a big flood. All of these things affect decisions that you make, and being able to discuss them openly. For instance, we talked about the insurance earlier on the show. We talked about the availability of housing earlier in the show. We talked about how the Inland Empire, how San Bernardino and Riverside counties are growing in population, but it's perhaps not, reflected in the way the home prices are going out, because we've seen home prices out there go down about 2.5% in the first quarter of this year. Okay, let's get to some news to use in this particular section. We have about a few minutes left in the show. I talked a little about the headline CPI. I think that's interesting. I put down here, is it corporate greed or is it not corporate greed? And I've talked about it on the show. I think it's corporate greed, a lot of it. I did see 2 different specials on TV, both purporting to be the truth. And this is the problem with the way media is delivered today. It really depends on where you watch it, who you watch, and how you get that information. I get my information primarily through reading it, and I read it through a number of different websites, which of course has their own manipulation process. But if you are a video watcher, whether you watch it on YouTube, whether you watch it on regular television, or whether you watch it on your laptop or your desktop computers, and traditional newspapers, I don't know, there's very few people who are younger than me that even know what a newspaper is, let alone read one on a daily basis. My wife reads the New York Times. I read the LA Times. There's things like that. So however you get your information is going to slant how you see a particular thing. So in this particular aspect of, okay, is it corporate greed causing inflation, or is it just the natural course of events because we flooded the market with money? I think it's a combination, although at this point, after all this time and after the actual federal money had stopped being given out 2 years ago almost, I think right now the one program I saw was a special that talked about, no, this is how we're going to prove it's not corporate greed, it's just a natural flow of events after an event like what we had in COVID. Then I saw another program on a different channel in a different way that it was delivered to me. It is corporate greed, and here's why. So as I said, in many things that we talk about on this show, we try to give an analysis based on some of the information. Now, the information is limited. I can't be everywhere all at once. I did love that movie. What was the name of that movie? Everything, Everywhere, All at Once? It was great. Won the Academy Award 2 years ago. It was about how the different choices you make in your life can affect exactly where you are in your particular universe, or your particular world, right? So if you buy that house today, in 20 years, how has it affected your life? If you don't buy that house today, in 20 years, how has it affected your life? It's an interesting mix of choice and then observation and then dealing with the perspective of that particular decision as you progress down and make different decisions based on the decision you just made. So my opinion is housing is gold. If you're in the market, now we're going to see a recession at some point. we're going to see house values depress at some point. 2008, after that crash in the mortgage industry that almost wrecked the entire world economy, house prices in the Inland Empire, we all know what happened. It went down 75% in some areas. 75%. It took till 2012, 2013 to those houses to be back out from underwater. Underwater meaning you owe more than the house is worth. Well, where are you now if you held on? You're looking at that decision to hold on rather than sell, or hold on rather than give back to the bank. That's a pretty good decision. You're almost paid off your house, probably. You're probably at least 20, 25 years into it. And now you're looking at retirement and a paid off house, and increase in the value of that house probably 100%, maybe even more. So that decision is actually a pretty good decision. But we did see that happen in 2008. We will probably see something similar, maybe not down 60, 75%, but certainly down 25, 30%. But again, real estate is the number one way by which most people make money or pass on a legacy. I remember when I was a kid, now again, this is the get off my lawn guy talking, but so when I was a kid, our house cost $5,000. And at that time, and I don't know why I was interested in that time, maybe because my mom was a real estate agent. However, at that time, if you bought a house, you could almost guarantee that it would be worth less when you sold it or you got rid of it 25, 30 years later. It was just the way it was. It wasn't the demand and the house price and the economics and everything that's happening since that time. Today, of course, if you hold on to a house for 25, 30 years, you can guarantee that those houses, go to the matrix, you can see them anywhere. Just dial up house prices in Southern California last 30 years, and you'll see the graph, and it'll show you the dips and the doodles, but it'll show a steady increase in value, and that increase in value is security in the bank. Now, as we talked about in this show, and we've talked about it recently because it's more of a recent phenomenon than a historical phenomenon, insurance is a big deal. That has to get solved. If you are of a mind or politically inclined, I'd contact the people who make those kind of decisions, whether it's locally, nationally, or in the State House. These are the people that have to solve this problem of insurance, whether it's California Fair Plan, which is the fire insurance that you get if you can't get regular fire insurance. But as our guest was saying earlier in the show, even the California Fair Plan is reducing the number of people on its rolls. I don't know what those people are doing in terms of fire insurance, because if you can't get fire insurance, your house is worth nothing. These are always concerns, but getting involved is the way to get the legislature on board. It's the homeowners here in California that really are the backbone of what we have. It's the stability in the state. It's the stability in the yearly in tax that we pay for property tax, whether it's in the county or the local municipalities. All of these people are really dependent on that value. Well, if you don't have insurance, you don't pay anything because your house is worth nothing. So get on it, call your locals, and let them know. I'm Jeff Barton, your voice in the mortgage industry. Appreciate you listening to the show, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
KCAA and KCAA Internet Television, the station that leaves no listener and no viewer behind.
Our food supply is facing total destruction. Big Ag and Big Farm are using new CRISPR technology to genetically modify every fruit,